with this, we move on to our next session. That's a Masterclass Alternative Investment, How to Find Stable Non-Correlated Returns by Mr. Ashwin Patni, Head Products and Alternatives, Access as Asset Management. A big round of applause for him.
Um, Hi, good afternoon, everyone. I hope I'm audible. Yeah, okay, great. Thanks. Interesting topic on how alternate investments can help us from a in terms of finding essentially the holy grail, right? Non-correlated returns. How can we use these to take us away from the vagaries of the day-to-day market ups and downs, and how does that whole thing work? First things is that alternates, it's a little bit of a catch-all phrase. How do we? It's something that it helps that if we can get our heads around to try and understand what all can encompass alternate investments. And the easiest way to look at it is that what is alternate is anything that is the other side of a traditional. Now, the traditional, it could be in traditional payoff structures, traditional asset classes, traditional mechanisms of investing, and alternate could therefore mean anything that we innovate or we go away from these traditions and give ourselves either a slightly different risk return profile, a different payoff structure, access to a different asset class. And that's where the non-correlation or the stability of return, the potential for that essentially comes into the picture. So let's start by just looking at typical asset classes. You look at the two traditional asset classes, right? The big two, equity and debt. And then if you look at alternate assets, the biggest difference is that uh, equity markets and debt markets essentially very well understood, very liquid, very deep, have their own ups and downs, have their own daily volatility. When it comes to alternatives, the power that really comes is in terms of just the ability to create a lot of differentiation in terms of the structures. So you can have patient capital, you can have the ability to hold back and invest at the time that opportunities arise. You can have deal specific investing rather than trying to buy the market by buying a basket. You can have different structuring options. You could be in an equity product, but you could have debt like features through some returns profile built in. You can be in a debt like product, but you can have equity structures through a payoff profile built in the end. You could have different asset classes. You don't have to limit yourself to equity, debt. You can be in different parts of the capital stack, but you could also be in, for example, a real estate or infrastructure or other asset class altogether. So that's really, it's a large space, but it also, the power of it is that it allows for a lot of flexibility or maneuverability in terms of what we can achieve. And I think the most important takeaway for me is that the ability of patient capital, that is one of the most key cornerstone things. Most of the alternate investments require a certain amount of time to a gestation to be able to deliver on that premise. And the minute you do that, it gives you a lot of elbow room to try out some of these things which typical day-to-day noise of equity and debt is not able to do. If you look at the Indian sort of alternative landscape, slightly dated, but I don't think the data's all changed all that much in the last year. Essentially, it's dominated by diversified equity-oriented investing. So, and again, it's not a surprise because if you think about the Indian market ecosystem, the most well-developed market that we had within alternates was the private equity market. We had a very vibrant ecosystem where we had global investors who've been investing for the last 20 years in the Indian private space. We've had a very vibrant equity market, which of course we all know. So therefore, exits are it's very much possible. So that's clearly the easiest space for the domestic industry to also sort of step in whenever this whole alternate space has opened up in the last 10 years. But what is also changing over time is that we are starting to see other areas pick up. Whether it is in terms of the sectors, you're starting to see whether it's real estate, infrastructure, commodities, some of the other asset classes coming in. You've also started to see credit, and some of the sort of hybrid structures again coming in. So that's the other thing, and that's also in a way sort of showing the maturity of the alternate space. And it goes back to the point about search for non-correlated, because at the end of the day, the equity payoff profile, risk return profile works in a certain way. But to really truly get the power of alternatives, having these other asset classes and having these other sort of capital structures really helps unlock that power in a much more way. So that really also brings out that whole point. So what's been the experience, globally? And globally, we all know that alternates is something that has been a huge part of global asset management in the last 30 years. That journey really started back in the 90s in a really big way, while of course alternates investments have always been around for a long term, but they really kicked off, I think, in the 90s. And one of the biggest driver was the arrival of a very, very stable low inflation regime. We have, as all of you, many of you who would have studied markets would recollect, very, very volatile interest rate and inflation cycles till about 70s, 80s, commodities, etc. And essentially, once the world got over that, and you had a regime where inflation was sustainably low, interest rates were sustainably low, there was suddenly a situation where, for institutional capital, who was used to making a certain high level of yield from their fixed income portfolio, suddenly the interest rate cycle went in a secular downtrend where the interest rates had to be very, very low for a very long period of time. And that forced a lot of investors, and you can see the similarities already, right, with our current situation. And that forced a lot of investors 30 years ago to hunt for alternative ideas which can give them that same yield, but not taking the day-to-day vagaries of the equity market and not the volatility which is there. So we, of course, 30 years saw fantastic equity market performance, but for a lot of institutional investors, family offices who didn't want that kind of a cycle, alternates provided that thing. And what you see here is that's the beauty of the alternate allocation, which is that across the risk spectrum, it doesn't matter where you fall there. You could fall in the most conservative side, where you are a more sort of fixed income heavy investor. You could be the more aggressive side, a more equity heavy investor. And wherever you want to be on the spectrum, adding alternates into your portfolio has seen over a 30-year cycle in a global context, a meaningful improvement in your risk return. Why does this happen? As I said already, what we have seen is that alternative investments have generated that alpha, have generated that secular return, and they have done so in a standalone way, which is not really correlated with the day-to-day thing of the market, because they invest in a different way. There is a logic to why that lack of correlation exists, and that logic is basically to do with the fact that you're investing in different structures, you're investing in different asset classes, different capital structures. The the coming back to India, what you're seeing now, therefore, is the same mechanism in a way playing out, where in the last 5 years you have seen, and in the most important, I think, policy decision of the last 5-7 years, 10 years if you had to take, I think the single one most important one is the formal inflation mandate that we now have for the RBI, right? So we all know very recently you had a situation where RBI had to write a letter because inflation is now above 6%. Now, many of us who've been around last 10 years, 15 years ago, I mean, we would have said 6% inflation was actually pretty normal, right? And to be in a situation where a 6% plus inflation requires explanation just shows the journey that we have come. And that is why I think a lot of us need to internalize that this environment which we had in India, where we could collect a lot of bond coupons which were very high, and which just allowed us a lot of regular income without having to do much, those days are more or less gone, and they're not going to come back for us anytime. And that is where alternate investments step in. Basically, what will happen is you will have increasing amount of financialization, increasing amount of innovation, increasing amount of formalization of the capital markets and opportunities. And that is what this alternate industry is able to tap into and create those payoff structures, which is able to tap into. The other thing that is also happening from an Indian context, which is also a massive game changer in the last 5-7 years, is institutional capital, which is domestic. Of course, in the past, we've always had foreign investors. We've had foreign institutional investors, whether it's retirement money, endowment money, other kinds of investors. In India now, we have our own insurance companies who have elbow room to invest into alternate investments. We have retirement money through different channels which have elbow room to invest into alternate assets. That is classical long-term 20-year, 30-year money that has the ability to allocate to risk assets, ability to invest into alternate assets, and can really create and incubate ideas into this space. So you will see a lot of innovation because funds are solving for example, an insurance company which has a need for a 10-year product or a 15-year product. And how do you do that? And how do you do that in a way which is not correlated with their bond portfolio or their equity portfolio? And that is, again, exactly the path that we already saw the alternate investment industry take in the West, in the big developed markets over the last 30 years. And we see a massive shift of allocation from a typical balanced portfolio, which was 70-30, 60-40 by endowments, by institutional investors, and moving more and more into hedge funds, alternates, private equity, credit in a structured way. And we have seen the benefit that grew. Again, if you see in terms of the allocation, not a surprise, private equity leads the pack. It's also the fact that equity payoff structures are the ones that are relatively easier to understand, but also I think to do with the fact that in India, as an investor community, we always try to shoot for the maximum return first. I mean, risk is something that people are aware of innately, but there is always that tendency to first, any new idea that comes, to first really focus on the return potential of that idea. So even in India, where the private equity market, I think one of the reasons why it has been the big beneficiary is because people essentially want to maximize their return potential. But I think as people have become better at this in terms of their understanding, in terms of their usage of alternates, and I think more and more institutional and family offices are using it, what we are seeing is that there is clearly now an awareness that it is risk-return correlation all going hand in hand. And that is where now you're starting to see the pie sort of splitting into multiple sort of fractions, and you're starting to see a lot of innovation coming in. I should mention here that, the fantastic thing that SEBI did in terms of just the way they have structured the whole AIF regulation itself, allowing for a lot of this to actually play out. And really, we are starting to see now the power of that. Just to give one example of us at Axis today, from a platform perspective, we have offerings which include credit, which include equity, which include real estate, which include special situations. And also which includes thematic listed equity. So it's just in terms of the breadth that it is possible across which we can have conversations with a family office or an institutional investor, is suddenly, it just creates so many different play out opportunities which are there. What has been the outcome? Again, some of this I have to use global data because the Indian data is still under development. So this is again frequent data for global market context. And the short answer is that alternatives have been delivering numbers, delivering returns. Whether it is the last 5 years, whether it is just going back even longer to the last 5 years, you could argue have been favorable from an equity market perspective. But even if you do go back last 15, 20 years, the numbers, the trends, the broad direction would actually be quite similar. And including what the prognosis is over the next coming years, I think the industries continue to benefit. And if you look at, I think the easiest way to understand this is if you look at the big global asset managers today, I think you're seeing a clear dichotomy where there is on the one side extreme simplification of asset management, use of passives, use of very, very simple and easy to understand and easy to sort of replicate strategies. And on the other hand, alternatives which are really giving you a lot of power to really structure and do very, very specific payoff structures, very, very different specific payoff profiles based on the need of the investor. And that is something that goes in hand in hand. So that one caveat which I will have in terms of these return numbers is that the whole fact is that this industry has so many different ideas, so it's always difficult to club it into together into one number, or all catching number. But having said that, the reality is that on a like to like basis, this industry has delivered numbers. And I don't have official numbers for India, but I did, just to rattle off a few, which Crystal has started doing some good job on benchmarking alternate returns in India. And I just have some numbers with just unlisted equity in the last 3 years. For example, CAT2 on an average have delivered about a 20% annualized return even in India. So that's the number. It's a number which is very competitive compared to listed, and this thing, of course, it's only 3-year data. But I have no doubt in my mind that given the opportunity set, the innovation that we are seeing, the kind of opportunities in the underlying economy that is getting thrown up, we will continue to see that opportunity to come up. Just to give one example, this whole area of REITs and InvITs has opened up massively the entire real estate and infrastructure opportunity. And we are seeing a massive financialization of real estate, a massive financialization of infrastructure, which 5 years ago or 10 years ago was not possible. And financialization along with institutionalization, and that is exactly the context in which an alternate investment manager or an institutional asset manager can go in, create some products, create some ideas for investors to participate in. And that's exactly what, for example, we at Axis, we have tried to do in one of our products. So with that, I'll pause here. If there are any questions or any comments, questions, are happy to take up.
In a lot of private equity deals, so I'm Prashant from Jaipur. In a lot of private equity deals, we see valuations growing by 3x, 4x, 5x in 5, 6, 7 years. But the challenge is the moment of truth is actually when you get listed. So till the time that listing happens, whatever valuation is being shown is actually the valuation at which deals are being done in Series A, B3, B, C, or D. So is that really real growth? Because how does an advisor like me justify the investment to them when this is, unless there are good exits happening, or else I only look at paper profits? So I am kind of confused when I look at that.
No, great question. And I think the answer is that, and that is one of the biggest challenges we've had, I think, last 5 years when we've been running, late stage PE funds, that investors who are new to alternates and are used to seeing essentially what is an NAV, and trying to explain that a paper NAV in many of these alternates may not really give you a good sense. So if you are, just to take your example, in a company where you've come in at, say, Series C, and company does a Series D, and then it takes 3-4 years of growth, and then you try and sell. While you're holding that company, it's very tricky to decide what the valuation should be. Ultimately, what really counts is the actual money that you get when you exit that company, right? So what counts essentially in my books is not paper profits, but real money that somebody's putting. Either as a fund, if you've taken a position and you have exited that, it doesn't matter if it's listed or not, but if you've sold it off, then somebody's put real money to buy that position. And that, ultimately is proof of the pudding. Or if we as a fund have not done it, but there are other transactions which have happened in the market, they could be used as benchmark. And then there is at least some sanctity to that valuation. But other than that, while you can always do, certain business linked valuation matrix, or you can use some market linked comparable matrix as reference points. But strictly speaking, those are theoretical. At the end of the day, what matters is what you get somebody to pay for that position when you want to exit. And to be honest, I think if you look at it from the fund's perspective, that's what funds do. What we try to do, for example, and I know that many other funds do the same thing, which is that they do try to handhold the investors, the partners, in a way to say that this is the position we've taken, this is the cost at which we've come in, this is how the journey of that company has been over the next 2, 3, 4, 5 years. And this is where we think the company is headed in terms of either a secondary exit into an unlisted or an IPO or a post-listing, which we're likely to get. So while you can't put a number there, but you definitely have a sense in terms of where that's headed, which you can at least use for your mental arithmetic. But At the end of the day, the short answer is it is the money that somebody puts on the table. There is no substitute for that. Everything else is paper.
Even PE fund, and a lot of PE fund, they are investing in the startup, maybe series 1, series 2, series 3. Particularly those who are entering at series 3, probably the valuation goes up. And what do we see? Yeah, there are various sectors, InsurTech, EdgeTech. There are many sectors, and they are all new age tech companies. And when we look at their profitability, in fact, except the wealth management or wealth tech sector, all other sectors are highly negative. And we have seen those who had entered the Paytm, 20 billion valuation, and now today, after the issue, 2 3 months, now it has come down to 3.75. Same is the case with the Trade Tech. Nika Corporation is better. Now look at the PV FinTech. There all PE funds had entered, and what has happened actually, the loss has shifted to the retail investor from the PE fund, because PE fund have entered and they have made the profit. After the lock-in period, they have exited. So how do we take care of this part? Means these are some astronomical valuation, 20 billion prior to IPO, and after IPO within 3 months now it is 3.75. Whom you are fueling means.
So I'll tell you a simple corollary. I think we do this study in Access every year where we take the top 100 listed companies, and we go back 10 years and say that of the top 100 companies, what are the experience of the best 25 and the worst 25 within the 100. And the shocking thing that you will find is that if you invest in the top 100 companies, this is the large cap basket. I'm sure most people are aware today now the SEBI classification, top 100 companies are large cap. So these are the most liquid large cap names in the country. And if you had the bad fortune of investing in the worst 25 large caps 10 years ago, your 100 rupees would not be worth 10 rupees also today. So it is not something that, I know that Paytm has caused a lot of pain to a lot of people, but it is not something that is specific to the tech sector. We have seen this in infrastructure, we've seen it in real estate, we have seen it in commodities, we've seen it in, so I'm not defending it. Let me complete my answer. The simple reality is that whether it is private equity, whether it is listed equity, any fund manager, the reality is equity comes with that risk where you can go right, you can go wrong. So what do you do as a fund manager, which is managing the risk of making sure that you're selecting the right ideas, making sure that your mandate allows you enough elbow room to then manage that idea. So whether you need 3 years, 5 years, whatever that horizon for that idea to work. And therefore, you use that to your advantage to make sure that you give the investors a good outcome. Now, what may happen is that you may get unlucky with 1 or 2 ideas in terms of the timing. The ideas themselves may be good, but the timing, because of when you come in or when you go out, because of the market, could cause some confusion. And that is where I showed that 30-year data, because ultimately to make money, and the simplest way we explain is, look at the listed market. If you had been with Nifty, what you do with 3 years or 5 years, you could still have losses. But if you go with 7 years, your losses become 0. If you go to 10 years, you never have even a negative experience. So the only way to get that cyclicality solved is you commit to that asset class as a long-term investor rather than just as an opportunistic investor. To your final point, loss making, profit making, ultimately see that any company, what you have to look through just beyond the reported profit or reported loss is what the business sustainability situation is like. Does it have the ability to make sustainable money? You are using that money to invest back for growth, or that business is not sustainable and the loss is just an unsustainable loss which is going to come back and catch you. So lot of excesses always happen in bull markets. It happens on the listed side, it happens on the private side. Lot of excesses did happen in the last 3 years. I think post-COVID, the industry saw a huge boom in tech usage and innovation and fundraising. So obviously a lot of excesses have happened. So everything is not defensible, but does it take away from the fact that long term this opportunity is not real? The answer is definitely this opportunity is real, and definitely there's a massive amount of wealth that can be created from here. But I think what we have to avoid is this blow hot, blow cold approach that we come in when everyone is talking about a theme, and then when the tough times come for the theme, then we hold back. That causes a lot more needless volatility, which is avoidable. I think we've run out of time, but just maybe one last question. Yeah.
Hi. Since we are talking about alternates, world over, we have seen that exotic options are embedded into structured products and sold to clients. Do we see growth in that sector?
I think India, the peculiarity of that is, we don't have a very well-developed option market in India for various reasons, including what is possible from an RBI SEBI perspective and all also. We have a very vibrant listed options market, but we don't have a very vibrant, structured derivative market. So I think it's a matter of time. I think the market will evolve. Also, the investors, also their usage of options. So I think one of the developments which is heartening is that if you see the development of long short funds, I think that's a great step in that direction, because people see the payoff structures. Everyone understands the linear payoff structures, right? The risk returns are easy because those are simple. But when the minute you go non-linear in your payoff structures, then it requires the understanding, the awareness to be better. And that's where I think the development of the long short industry is a great way to get there. I think so. I think short answer is I don't expect anything much to change in the next few years, but I think in the medium term, definitely you'll start seeing some of that as well.
Thank you.
Okay, great. Thanks, everyone.
Once again, a big round of applause for him, everyone. With that, I would request Mr. Amit Kishore Puria to come here for the felicitation. Thank you for such an interesting session. A big round of applause for both of them. Also, I would like to once again mention the contest that we are having on social media. Please do tag Equalify and do mention the best message or the best quote according to yourself along with a picture.